What's up, traders? I'm really excited to make this video in collaboration with Best of Us Investors. I've had a lot of great talks with Carrie, who I've come to respect as a very wise and accomplished fundamental investor. But I don't think that fundamental investors oftentimes appreciate technical analysis. I see that as a challenge. I want to show traders and investors some very simple technical analysis that's going to help them make better decisions. This is going to save a lot of money and a lot of headache. And it's a very simple pattern that you can recognize once I point it out to you. We're not going to look at lots and lots of lines. We're not going to look at fancy chart patterns. Let me first say what my philosophy of technical analysis is, or rather, what it is not. Because a lot of people think that technical analysis is astrology for men or predicting the future. Well, that's not what it is to me. Technical analysis to me is about pattern recognition. We look outside and we see clouds. We think rain. We know the behavior of our friends and our colleagues. We seek patterns. That's what our brain does. And by looking at a price chart, you can oftentimes see the behavior of all the market participants and recognize the habits and the patterns that they go through. To look at this, I'm going to be using TradingView. And I have on my screen Japanese candlesticks. Now, this is going to be the only real fancy part of this tutorial. Bear with me if you know this already, but it's very important that we understand what each candle represents. Now, there's a lot of different candle patterns out there, but my brain is only so big. I can only remember a few, or really none. There are four main components to a candlestick. That's the open, the high, the low, and the close. And that's going to be important with us going forward. So, really quickly, if we have a bullish day like we did on January the 3rd of 2022 on Apple, then the open would be at the bottom of the bullish big fat bar right here, the fat part of the candle. The close is going to be at the top part right up here. And that's what represents the open to the close on this candle. Now, of course, you have a high, you have a low within this period, and that's going to be the wicks that we have up here. That's a high wick and the little bitty low wick right there. Okay, that is a bullish candle. The opposite is a bearish candle. We have an open at the top part of the fat part of the candle, and we have a close at the lower part of the fat part of the candle, and that is a bearish bar. And of course, we have our high and our low, which are still the wicks on the upper and lower side. Okay, that's all we got to learn about candlesticks because this is what's going to be very important. Let's look at a pattern that is going to help you identify when to get out once the momentum has faded and the story is no longer being believed by everyone. Story time. Let's go back a year to 2021. Exactly a year almost. So if you recall, in 2021, there was this meme of short squeezes. And every few years, there's something in the financial media about how silver is going to short squeeze, or if you buy silver, you'll force all the hedge funds to have to cover, blah, 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 blah. This happens a lot. And that was no different last year at this time. There was this idea going around in the financial media and on Reddit trying to get people to buy silver, specifically the SLV, the Silver ETF. Well, February the 1st, 2021, they opened, remember our red bar, they opened at about 27.75, which broke a high that was made in silver back in August of 2020. But look at our candlestick. Within that same day, we closed back inside this high. In fact, the week itself, which is this bar, it's a weekly bar, closed well inside that high. It even closed back inside this range. That's a warning sign. You need to pay attention when something like this happens. I know that the story was that this was going to push up higher, but nobody bought it. If this was going to go, it should have gone. But what the close of the end of the week told you, that you can see on a chart, is that the buyers had failed to push it higher. And you really needed to pay heed to this, because in the weeks that followed, it sold off from there. And in the year since that moment, from the close of that week, the SLV is down 15%. Not good for the people that bought the narrative. But you had your warning if you were paying attention and you knew what to look for. Now, this works in just about everything that you can buy or sell. That's what I believe, because I see it all the time. Let's look at a stock. Spotify, a very popular IPO from yesteryear. Let's look back on February, again a year ago, 16th, 2021. We'll go to the daily and look at it. So we made a high on January the 13th, right about here, 370. We'll call it 371. And then on the 22nd of February, 2021, buyers tried to break it out and they touched close to 390. But within that same day, it's very clear here to see, they failed to push it higher and price closed back inside that high. Warning, danger, Will Robinson, danger. And traders really needed to take heed to this then. No matter what they thought about the company, the fact that they couldn't push it higher was a warning sign. And so far, Spotify has never traded higher than that warning sign there. It's very powerful. How does it actually work in reverse? When can it actually show us a good setup? Well, we'll also use Spotify for that. Spotify made a major high after its IPO at 199 on July the 26th, 2018. We now returned in May of 2020 to retest those highs. And as it hesitated on the 17th of June, 2020, if we zoom in and we look, we actually had a close above that high. Maybe it's just noise, but that's our first sign that we actually legitimately broke the high. That's good. If you're patient, you could wait for another day to confirm it. This is good. This is bullish. This can be a sign that you want to take a breakout if you want to own Spotify, so long as you pay attention to the warning sign on the other side at the top. It's very simple to just look for a close above past major highs. That's the pattern that we're looking at here. Let me show you one more. We're going to look at the euro dollar. These are the two most traded foreign exchange currencies, the most traded pair in the world. I cut my teeth on Forex many years ago, and so I remember this event. This actually shaped my philosophy of this particular pattern, in fact. So we made a high on the euro dollar in March of 2014. 2 months later, May, specifically May the 8th, 2014, price on the euro dollar broke the high that it had made prior, and then within the same day, closed back inside the high as well as the range. This is the most traded foreign exchange pair in the world from two of the largest economies in the world, and you had a false breakout in the price, which signaled a massive bearish trend off of that high that lasted for well over a year and represented a nearly 30% change in the value of two of the world's most used currencies. It's a very, very powerful tool, and it all begins with this. It all begins with a failure to break higher. So now that you see this pattern, and yes, this is technical analysis, it's very simple. You really just have to know where the close and the highs and the lows are. I hope that you can use this in your trading investing to save yourself a lot of headache if you're in a position and you don't know when to get out. Pay attention to this. The reason I make these videos is to help people out, to share what I've seen in the years of my trading. If you like the video, make sure that you like, share, subscribe, do all the things that the algorithm likes, because I just want to get this message out there to people to make them better investors and traders. So hope to keep doing this for y'all. We'll see you in the next video. Trade wisely.